What's going on, guys? Ben here with HighStrike Trading, and today we're going to be talking about the top 5 mistakes that new traders, and let's face it, some experienced traders make all the time. These 5 mistakes are heartbreaking because a lot of people don't even know that they're making them, and they're the easiest things in the world to fix. So let's try to identify some areas where maybe you're making some mistakes and try to potentially fix those mistakes for you going forward. Number 1, you probably guessed it, is over trading. This means trading too frequently or too often, where you're getting into positions that aren't actually good positions. You just think that you need to put your money to work, so you take a trade for a couple of reasons. 1, to either make back the money that you just lost, or 2, because you think you're on a heater, you put more money back into the stock market because you think all stonks go up and you must be able to make money, on the next trade. The reason why over trading is bad is because you're forcing positions as a trader. And as a trader, you never want to be forcing anything. You want to let the market come to you, make decisions based on the information that you're seeing, not try and put your bias onto the market and force yourself and convince yourself that there's a trade there just because you want to put your money to work. So if you are an over trader, you probably know it. You're probably entering positions, between 2 and 30 minutes after you close the position. You're probably trading, 5 to 10 times per day, or, you're getting hit with that PDT flag quite often because you're trading so frequently. Try and just take a deep breath, take 30 minutes after every trade, decompress and analyze it if you think that you're an overtrader, and then come back to the market refreshed and never try and force the position. This is a pretty easy fix. You just need to be patient and identify opportunities, not try and force them upon the market. The second mistake that I see, guys, and quite frankly, I don't really understand it, is no risk management. It's when people get into a position and they assume that the stonk is going to go up, and so they don't have a plan to close the position if it starts going the other direction, right? If you get into a position, you need to have a contingency plan if it goes up, and you need to have a contingency plan if it goes down. You need to be able to know when you're going to cut your losses, because obviously you're not going to let that position run to zero, especially if it's an options position. That thing is going to lose value faster than, any stock position at all. And you need to be able to have that risk management and the self-discipline to take yourself out of that position. So if you do not have an exit plan on the upside and on the downside, you need to rethink that before you enter your position. So when you enter your position, you just have 3 things. Cam, throw them right up here. You need to have an entry plan, an exit plan if it goes your way, and an exit plan if it goes south. Which brings me to my next point, is mistake number 3, is that people don't have a trading plan. If you don't have a trading plan, you don't know when you're going to get out of your position. You could let emotions take over. A lot of different things could go sour for you in that position. And if you don't have a trading plan to look at and go by, you're going to get overwhelmed, and chances are you're going to do something that you wouldn't have done if you had the time to think about it. So a good trading plan, just like we just said, is entry point, exit point if it goes right, and exit point if it goes wrong. Another huge important part to having a good trading plan is identifying proper position size, right? We don't want to be putting our entire account on a very speculative position, because that has the opportunity to lose more money. So we want to dial back our position size, etc. If you don't know what goes into a trading plan, I'm going to put my trade tracking worksheet in the description below. Just click that link and you can download my PDF. It looks like this. Every aspect of every trade that you can record and reflect on later. And number 4, guys, the 4th biggest mistake is people get too emotional, right? If you're in a trade and it starts to go either your way or not your way, your emotions take over and you make decisions that you otherwise wouldn't make. So my advice in terms of controlling your emotions is to start with $100. You can also check out my Rule of 30 video. I'll put the link right here. And that pretty much goes over how to scale up your account in factors of 10, so that you can control your emotions in stages rather than just blasting yourself with, a potential $1,000 gain or $1,000 loss. So if you feel emotions starting to take control of your trading, you realize that you're making decisions that you typically wouldn't make. Dial back your position size. I know it's going to be annoying to be trading with less money than you'd like to be, but the thing about emotions is you can't just immerse yourself in the stock market and expect your emotions to react. You need to be able to scale those emotions up. So if you're someone that's emotional, please scale down, take time to do it the correct way, and scale back up as you can get your emotions into it. And number 5, guys, one of the biggest mistakes I see of all time is your expectations are way too high about trading. A lot of people think that trading is, a way to just get rich really quick. They've seen other people make money in the stock market. They see people having success, all these nice things. So they think that trading is their ultimate ticket to life on a beach somewhere. That's not the case. Trading is something that you have to work very hard at to make small returns consistently. Small returns consistently will then add up to a lot of money one day, but you need to be able to do that on a very small scale, right? So if you're someone that's risking too much money in order to get a very immediate reward, chances are that your expectations are too high and you're risking too much money, and it's just going to end up coming back to bite you, because even if you do succeed at a couple of trades with a very high risk level, you're going to end up losing that money at some point if you continue risking the same amount of money. It's just a law of large numbers. So there it is, guys. 5 mistakes that I see every time. We'll put them right here. Over trading, no risk management, no trading plan, too emotional, and your expectations are too high. If you are someone that thinks that you may be suffering from any of these 5 diseases, these heartbreaking diseases, guys, please take some time to reflect, listen to this video a few times if you need to, and figure out how you're going to overcome these 5 weaknesses. Because if you're able to do this, guys, these are the 5 most common mistakes. And if you're able to get over these, I guarantee you your trading is going to be a lot more successful. So I really hope that I've earned your thumbs up in this video. Please subscribe if you haven't already, and I'll see you in the next video. Take care, guys.